Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So as you all know, today is Thursday. We only have one day left to end the week, and you've had the better part of volatility in the markets. So apologies for that. So today we'll be looking at a couple of things that are currently happening in the markets. We'll be looking at the economic calendar, trying to understand what was happening yesterday, what's happening today, and what you're expecting tomorrow. And of course, the major key events for next week. So once you join in, kindly say hi on the live comment section, and these will confirm that everything is working just fine. So this week we have had quite a number of news announcements. So I'm going to skim through it quickly. First things first, we had the monetary policy meeting minutes, where the Reserve Bank of Australia was very keen on maintaining the note that they are not looking to hike interest rates further. They are willing to hold rates at the current level of 4.10% unless something really forces them to go for another rate hike. So they are very confident that the current interest rates are basically sufficiently restrictive, which basically implies that they're in a level that should push inflation back to the 1 to 3% inflation target. Then we had the big surprise coming in from China. So we had a sequence of negative data news from China, including industrial production, which slowed down to 3.7%, retail sales 2.5%, and fixed asset investment slowed down to 3.4%. So there was an immediate response from the People's Bank of China, where it decided to cut interest rates by 15 basis points down to 2.5% for the medium-term loan facility. So this basically means that China is looking to do more easing, and as a result, try to stimulate more economic growth, since the economy is really slowing down and there's a brewing crisis in the real estate sector. Besides that, there is a recent flood that is currently affecting some provinces in China, and it's having some business impact that is basically slowing down growth. So Chinese unemployment rate rose to 5.3%, but for the youth between 18 and 21 years, it rose to slightly under 20%, and the People's Bank of China decided not to continue reporting that data point. Japanese industrial production improved to 2.4%. And then we had the big surprise in UK jobs data, where the claimant count change, or the number of people claiming for unemployment insurance for the first time during the past 1 month, increased to 29.0K, basically meaning that there is more and more people who are unemployed, leading to the belief that the job market conditions are softening. So average earnings index rose to 8.2%, and the unemployment rate rose to 4.2%, which is quite consistent with what the Bank of England is looking to achieve. Then later on, we had the Canadian CPI, which came in slower than expected at 4.8% compared to the previous reading of 5.1%. So this is well according to the expectations of the Bank of Canada. Then we have the core retail sales. This was also a big surprise. A very strong American consumer is evidently continuing to buy more stuff, with core retail sales being up 1.0% compared to a previous reading of 0.2. So Empire State Manufacturing Index showed a contraction, basically indicating that manufacturing conditions are worsening, and this could be leading to a recession, and this is for New York. Then retail sales overall number was up 0.7%, way higher than expected, while import prices on the rise at 0.4%, which basically indicates that we could be seeing high inflation going forward. So Canadian core CPI month over month was up 0.5%. This was quite discouraging, considering that the Bank of Canada was considering holding rates at the current level, but with more inflationary pressure, then there could be a chance that the Bank of Canada may have to go back to the drawing book and consider another interest rate hike. So for Reserve Bank of New Zealand, they chose to maintain interest rates at 5.5%. And then UK inflation dropped to 6.8% from the previous reading of 7.9%, Core CPI remained at a 40-year high of 6.9%. And this was quite worrying, basically implying that the Bank of England may have to go for stronger rate hikes. So then later on, we had the FOMC meeting minutes. This was last night, where we saw a divide in Fed members. Some Fed members are concerned that inflation could rise again. So if inflation happens to rise again, then they may be forced to go for another rate hike. So the Fed members that were worried about inflationary pressure coming back were about 7. So they won the majority. That's why there was a 25 basis point hike. And now data is proving them right after US CPI came in at 3.2%. So for the other members, they were worried that the Fed is over tightening policy, and they felt like the 5.50% rate level was sufficient, and they didn't want to over tighten the economy, which could be disastrous. So now that we have a divided Fed, also we have divided investors who are wondering whether the Fed will go for another rate hike on the next meeting on September, or whether they are going to maintain the current level. So from the last meeting, the Fed decided to adopt what we call a data-dependent approach. And from the data-dependent approach, it basically means they will be considering the data between July and September to make a decision. So the most interesting part is next week, where we will be having the Jackson's Hole Symposium. So this is an economic symposium that happens every year at the Jackson's Hole Symposium. And in this event, central banks from around the world, economists, as well as policymakers will meet, and each will discuss their own economy and what they expect to see going forward, and of course, the monetary policy they are currently practicing. So among the major highlights and interests is a keynote speech by the Fed Chair Jerome Powell, and of course, a keynote speech from the ECB Chair Christine Lagarde. So everyone will be watching and following that meeting closely next week, since there usually causes a lot of volatility in the markets. So that will be the next speech before the Fed meets in September. So then today, we had quite a number of data points. For Japan, home machinery orders were slowing down. They were improving from the previous reading of negative 7.6 to 2.7% positive. This was slightly below expectations, but yet an improvement. And of course, the trade balance worsened a little bit, and this was not a very good data point for the economy of Japan. So jobs data in Australia, we saw the economy losing 14.6K jobs in the month of July. This was not very promising, but also for the Reserve Bank of Australia, it's well within expectations. They are looking to weaken the job market. So with the unemployment rate rising to 3.7%, it's consistent with what the Reserve Bank is looking to achieve, but not consistent with what the people of Australia would like to see. They want to see a full employment where everyone has a job. So then later in the day, we had the unemployment claims where they came in slower than expected. So slower unemployment claims basically means that there is less people claiming for unemployment insurance for the first time. And this is a weekly data point, meaning that this number is slowing down from a previous reading of 250K to now 239K, meaning that the job market is very tight. So the Fed is not looking at to have a tight job market. They want the job market conditions to soften and more people to be claiming for unemployment insurance. So as a result of this, we will be expecting to see the Fed considering another potential rate hike. So another data point that the Fed doesn't like is Philadelphia Fed Manufacturing Index improving massively from a previous reading of negative 13.5 to the current reading of 12.0, meaning that the manufacturing conditions in Philadelphia are improving, which basically leads to higher employment, higher wages, and as a result, potentially higher inflation. So going forward, there's these mixed data points, implying that investors are not very sure whether the Fed will go for another rate hike or whether the Fed will maintain the current level. So a key indicator that we normally follow is the FedWatch tool, which basically tracks the Fed CME Fed futures. So it basically is used to predict whether the Fed will go for a rate hike or not. So 2 days ago, this was at around 9%, and this has now risen to 13.5% after the Fed meeting minutes yesterday. So there is this pressure on this side increasing, which indicates the probability for the Fed hiking interest rates on the next meeting in September. However, the overall consensus is the Fed holds interest rates level at 86.5 percent probability. So in this case, we'll be seeing interest rates remaining steady at between 5.25% and 5.50%. So with this in mind, we know that tomorrow is also a very nice trading day. We won't be expecting much from the economic calendar. The only key data point will be the retail sales from the UK, and of course, the Eurozone final core CPI, which is basically a measure of inflation. So once you see the measure of inflation, then we'll know how to trade the euro accordingly. So for now, if you look at the charts and how they're behaving, I don't think I was sharing that chart. I'm seeing some good comments here. Hi, Emmanuel, Luca, I can see J Squad, Richie, Lemuel, and Apollo. Why does Philadelphia and Empire State Manufacturing different? So these are two different states. So we normally track these states as a leading indicator of the overall economy. So I'll give you an example. When you're tracking what's currently happening in, let's say, the Eurozone, we look at the leading economies. We'll basically track Germany. So if manufacturing conditions in Germany are doing well and Germany is growing really well, which is the biggest economy in the Eurozone, then overall you expect the Eurozone to be doing well. So instead of tracking all the manufacturing activity happening in the US, we look at the leading states in terms of manufacturing and track those manufacturing conditions. So if they are largely improving, then you expect the overall economy to also be improving. So that's why we track the Empire State, which is the New York, and of course, Philly Fed, which is Philadelphia. So for New York, we saw weakening and worsening conditions, but then we have a conflicting data point where Philadelphia came in better than expected. So those are two distinct states which have different business conditions and of course different jurisdictions. So in this case, we are seeing a mixed data point. So to answer your question, why are the state manufacturing different? Is because the conditions of manufacturing in both states are completely different. So yes, they are within the same country, but the conditions tend to differ according to state laws, state policies, and of course the different conditions affecting different populations between the two states. Please share the calendar. Apologies, I completely missed that. So for your consideration, Rufas, this hypothesis true or false, use DXY as your standard measure of bias against including majors, not limited to gold. Yes, that always works. Always use the DXY. So the DXY is a measure. It's a benchmark that measures how the dollar is performing against a basket of 6 other currencies. And this is majorly the euro, which has the highest weight. We have the pound, we have the Japanese yen, we have the Australian dollar, New Zealand dollar, and the Swedish krona. So when you follow the DXY, you're trying to understand the strength of the dollar. So when you know the strength of the dollar, then you can know how to treat these other majors. So in most of the times, you'll notice a very strong correlation. So for instance, if you look at the recent performance of the dollar, so over the last 5 hours, we can see it's a strong bullish momentum in the dollar, where it's recovering from earlier losses. So as a result of this, if you look at pound USD, then you should expect to see the same. So in the last 4 towards the 5th hour now, it's the pound losing against the strong dollar. So if you look at the euro, it's the same thing. It's the euro losing against the strong dollar. Almost perfect correlation, almost similar candlesticks. Then you go to USD JPY, it should be the opposite direction, but the same. So the last 4 or 5 candlesticks is the same. Dollar gaining against the yen. If you go to USD CAD, same kind of setup. Dollar gaining against the Canadian dollar. If you go to Audi USD and you look at the last, let's say 4 or 5 candlestick, same kind of formation, a dollar gaining against the Australian dollar. And if you look at another currency pair, let's see hotels. So USD against the Swiss franc, same thing, dollar gaining against the Swiss franc, and almost all these candlesticks tend to take the same pattern. So now knowing that, you know that the dollar index is a benchmark that basically shows you the strength of the dollar. You'll know how to treat other major pairs. So as for gold, look at this. So last 5 hours, similar price action, dollar gaining against the price of gold, but then gold seems to be more aggressive compared to the majors. So that's why we have a very strong momentum happening here. So I was expecting early in the morning that this was the major test here, which was the Jones Law. I think it was June 29th. And now the market bounced off strongly here. So the bounce played out as expected, and the market rallied to the previous high. So we had projected that the market would go up, get to this level, which is basically the 1902. So it actually got to that level, didn't quite break the level, and changed direction immediately, went back down, broke today's low, and now it's moving significantly lower. So what we are basically experiencing is a major breakout in gold prices, which could potentially extend towards the lower trend line. So with a stronger dollar and more data indicating that the Fed will continue hiking interest rates, then it basically implies that gold could continue trading downwards, and this is not the bottom we were waiting for. So we were expecting to see some form of bottom here and gold taking a direction upwards. But then following the data that we saw, remember, we are in an environment where we are following a data-dependent approach. So every time there's new data, then it's interpreted differently. So the way we are interpreting this one is that if the Fed keeps going, getting data that supports another hike, then it will definitely go for a hike. And as a result, a strong dollar versus other weaker assets. So the weaker asset would be gold, pound, euro, Australian dollar, the yen, and so on. So another key chart to be concerned about is the USD CNH, where we saw over the week the banks or the state banks in China buying dollars in the open market, especially the London session, and this is trying to intervene and support the Chinese yuan, which has been a long-term losing to the dollar. So the previous high here was 7.28. So we normally know the yuan are trading at 6 point something. So anything above 7 is considered as extremely weak for the Chinese yuan. So the Chinese yuan have to spend currently, or the Chinese have to spend 7.3 yuan to get a dollar, and this is quite negative for them, and it's also a previous high here of about 7.3. So whenever you get to such high levels, it tends to affect the Chinese economy negatively, and they don't want this to happen. They want to stabilize their currency. So that's why they are doing an intervention, and in the intervention, they're trying to support the Chinese yuan. So as a result of this, there's this potential that the Chinese yuan will continue gaining against the dollar as long as there's intervention. And in this case, you could be seeing the Chinese yuan getting back to the lower trend line and potentially even below this. So an intervention is a direct, basically a direct factor impacting the markets. And if the People's Bank of China is looking to support its currency, and it's already doing so, and it's implementing measures, then you don't have to fight the central bank. So there's a very common saying that we normally say, don't fight the Fed. And this applies to when you're trading US assets. So in this case, if you're trading the Chinese assets, then don't fight the People's Bank of China, just follow its direction. And in this case, the direction seems to be bearish for the USD CNH pair. So Bitcoin seems to be cruising down below, save for the last 1 hour, where we had a strong rejection of lower prices. And now what we are seeing is some potential for reversal. So in the morning, I was suggesting that we look for a bullish entry here. We didn't have any candlestick suggesting that buyers have entered. So in this case, there was no reason to go for a buy trade. But now from the price action of the last 1 hour candlestick, and now we are back to 28,000, there's a good chance the market could go back higher. So for European equity indices, they continue selling after the small pullback they made in the morning, back to this area here. And if you look at the French 40, it's the same story. So after making some big jump and getting to our target, not yet here, then there was a sharp drop as we approached the New York session. So for the American equity indices, we had a bounce from this one trend line, market went up and then went back to retest the area, and now it seems more bearish than bullish. Same case applies for the NASDAQ, for the Dow Jones and the NASDAQ, also the same. So there was a strong rejection here, market rallied for a while and then went back downwards, and now we are seeing strong bearish momentum. So for AUD/USD, after rejecting here, and now we are seeing a strong dollar, then there's a good probability that the market could be retesting today's low, and today's low could also be tested for pound-USD as well as euro-USD. So in this case, market going back to retest this low. And of course, for pound-USD, same thing. Market has already rejected this resistance and could be headed back to this area here. One key thing to notice is that we have a double bottom already formed on pound-USD. So as I'll be mentioning to you guys, I'm very bullish on pound-USD. I expect this market to, at some point, start behaving and presenting us with trading opportunities towards the upper side. So what we are seeing here, and I'll try to plot this nicely, is a market that has found some form of support here. So you can see the longer term trend line is following this path here. So this is since September last year. So an year-long trend line has been broken, and the market was forming this particular bearish channel. So in a bearish channel, you expect to see lower highs as well as lower lows. So what we are seeing in the most recent price action is the market forming a low and then going for another low that is equal, meaning that the market was unable to form lower lows. And now we can see the market completing the double bottom pattern. This is the W-shaped pattern with this area highlighted in yellow as the neckline. So today we saw the market go for the neckline, and immediately it got to the neckline, it basically pulled back downwards. So the idea is to be patient and wait until the market breaks the neckline. So it doesn't mean that you buy immediately after seeing the W-shaped pattern. It only tells you that the bear momentum has weakened. We already have an equal high and an equal low, meaning that for this area, the market is naturally moving sideways. And if there's a break upwards, it basically implies that the trend has changed. And now we could be seeing the market headed higher. So just be patient and look for the appropriate area to make a market entry. Another good question from Annette. Looks like the dollar might be strong for a while. Any views? Yes, the dollar might be stronger for a while. We are seeing a lot of strong data coming in from the US. So since the last meeting of the Fed, we have seen a very strong GDP. This is not consistent with the Fed. We have seen a very strong inflation report, still not consistent with the Fed. We have seen a very strong wage growth, but then for the number of jobs, they disappointed, but wage growth is a key concern. So the average earnings went up higher than expected. That is a key concern for the Fed. We also saw a very strong retail sales report. So that was also quite concerning for the Fed. So the Empire State Manufacturing Index was quite consistent with the Fed, but then today's Philadelphia Fed Manufacturing Index came in very strong, and that was not very good for the Fed. And now all those data points are now supporting potential for another rate hike. So in that case, a rate hike implies a stronger dollar. So we could be seeing the dollar complete the week on a high, and then perhaps we'll be having something different next week. So next week, all eyes will be on the what we call the Jackson's Hole Symposium. I don't know if it's in the economic calendar yet, but we can check. So Jackson Hole Symposium, I don't think it has been added on the calendar yet, but I can check right away. Jackson Hole, it's called Economic Symposium. So it's an annual event. It will be starting on the 24th of August and moving through to 26. So it will be starting on Thursday next week. So the theme for this year will be structural shifts in the global economy. Of course, we have seen several structural shifts happening in the global economy. One of them has been a very common theme, which is the energy dependence. We saw the bombing of the Nord Stream pipeline, and now the Eurozone is depending on Africa, as well as the US on its energy supplies, as well as the Middle East. We have also seen a very common theme in the year of de-dollarization. We have also seen a lot of fight happening in terms of microchip sufficiency, where the US has been banning exports of top-level microchips to China. So there is a lot of things that have been changing structurally. We have also seen the US almost get a soft landing with inflation coming down, high interest rates, without getting into a recession. So all these will be discussed during the Jackson Hole Symposium. So it will be happening in Oklahoma. So we'll be seeing Kansas City host dozens of central bankers. We'll be seeing policymakers, academics, and economists from around the world, and its annual economic policy symposium in Jackson Hole, Wyoming. So it will be a key event influencing the markets, as all investors will be focusing all their eyes on their favorite central bankers, trying to understand what they are presenting, what questions they are being asked, and how they respond to that, in order to get hints on oncoming monetary policy. So that's it for the day. Thank you very much, guys. If there's any more questions that I have not answered, I'll take them. But so far, I don't think I've missed any. So enjoy the rest of the night. And of course, tomorrow we'll be having another session at 11 a.m. It will be hosted by Samson Zera from Eldoret. And hopefully you get to join the session and raise your question, understand what's the update for the day, and of course, identify trading opportunities. So if you enjoy these sessions, consider subscribing to the FX Pesa channel, sharing these particular sessions with your friends, as well as other trading communities, so that we can all grow together and get to experience peaceful days.